Every trader talks about discipline, patience, and strategy, but very few actually sit down and build a proper trading plan. And that's why most traders fail. Now, in this video, I'm going to break down what a trading plan really is, why you need a trading plan, and how you can build one step by step. So by the end, you will have a clear framework you can apply immediately in your own trading. Now, let's see why we need a trading plan. Now, let's be honest. Most traders fail because they don't have a plan. They wake up in the morning, open their charts, and instantly start chasing whatever candle is moving. If price is pushing up, they are buying. If price is dropping, they are selling. But when it doesn't go their way, they panic, they close early, or jump into another pair. That cycle repeats until the account is actually gone. A trading plan is your anchor in the chaos. It removes the guesswork. You already know when you will trade, what pairs you will focus on, and how you will execute. That means you are not constantly second guessing every decision. And here's the deeper truth: without a plan, you are trading based on emotions. Every win feels like you are unstoppable, every loss feels like you are cursed. That's an emotional roller coaster that burns people out. A plan gives you balance. It allows you to treat trading like a business, not a casino. Now, let's talk about the components of a trading plan. So, what actually goes into a trading plan? Think of it like a business plan. No serious company runs without one. Your plan should cover these five key areas. The first one is the market conditions you trade best in. The second one, the pairs of or instruments you will focus on. The third one is your entry strategy. The fourth one is your risk and money management rules. And finally, your review process. Now, most traders only focus on the middle part, entry strategy. But the truth is, your edge is not about entries. A plan forces you to think about the bigger picture. What times of the day do you trade best in? Do you perform best in London or New York session? What kind of setups gives you the highest probability? What maximum risk are you willing to take per trade? And by writing this down, you remove randomness, you give yourself structure, and you understand that the structure is what separates amateurs from professionals. Now, let's start with choosing the pair and session times. Now, one of the simplest but most powerful parts of your trading plan is deciding what and when to trade. Now, I see too many traders jump from Euro USD to gold to trading crypto to indices all in one day. My dear traders, that's not focus. That is simply chaos. Professional traders usually specialize. They might only trade one or two pairs, but by doing so, they will learn the personality of that market. They will understand how gold reacts to news, how Euro USD moves during the London session, how US 30 maybe behaves in the New York session. That knowledge comes from focus, not from chasing every move that you see. Session times matter too. London session is known for breakouts and volatility. New York often gives us reversals or continuations, and the Asian session is typically slower and with smaller ranges. Your plan should determine which session you will be able to trade in, which session you will be active, and why. That way, you are not chasing time, staring at a dead chart during hours that don't suit your strategy. Now, the entry criteria. Now we get to the exciting part, your actual entry model. But here's the mistake. Now, most traders think that an entry model is enough. But the truth is, an entry model without context is just guessing. In your plan, you need to define your entry rules clearly. What must happen before you pull the trigger? Is it a break of structure? Is it a retest of another block? Is it a rejection at a key level? Write it down. Screenshot examples and make this process repeatable. The power of having rules is this: when you are in the live market, emotions are high, right? If you are deciding in the moment whether this looks good or not, emotions will trick you. But if you have written rules, for example, I only enter if price breaks structure, retests and shows rejection with confirmation candles maybe, then you will either wait for that or you don't. There is nothing like debating, and that is the discipline that saves you from impulsive trades. Another thing, you need to have risk management rules. Now, this is the part everybody says they understand, but almost nobody respects. Your risk rules are the difference between surviving and blowing the account. Your plan should define what percentage of your account you will risk per trade, what is your maximum daily loss, and what is your maximum drawdown for the week. For example, if I risk 1% per trade, if I lose 3 trades in a day, I will stop. If I'm down 5% in a week, I will pause and review. Why is this so important? Because it protects you from yourself. We all know that after a losing streak, emotions tell you to double lot sizes and even chase the losses. This is why you try to make back what you have lost. That's how accounts are destroyed. A plan gives you rules that stop you from self sabotage. Think of it in this way: in trading, defense wins games. It's not about how fast you grow your account, it's about how long you can stay in the game, and that is where risk management keeps you alive long enough to see your edge playing out in the markets. Now, let's look at journaling and review. Now, this is something that most traders ignore, and that is journaling. If you don't track your trades, you will never improve as a trader. Your plan should include how you record the trades. It can be as simple as a screenshot with notes, why you took it, where you entered from, how it ended. Over time, this builds data, and it is that data that shows you patterns you would never see otherwise. For example, you might discover that 70% of your losses come from trading the Asian session, or that most of your wins come from retest setups, not breakouts. Without a journal, you are blind. With a journal, you are learning from your own experience. Trading is not about avoiding mistakes, it's about learning from them quickly. And the fastest way to learn is to document and review. Traders, make sure you review your trades. You can review them even in the weekends, it's very okay. And finally, consistency. You cannot improve what you don't repeat. If you change your trading style daily, how will you ever know if your strategy is working? With a plan, you track results over weeks, months, and even years. And that's where growth comes from. Without one, you are not trading, you are gambling. And remember, gamblers don't last long in this market. So let's bring it all together. A trading plan is not about making you perfect. It's about giving you structure, rules, and consistency. It is your anchor in the market that will always try to pull you into emotional decisions. The traders who last, the ones who succeed, are not the ones who chase the biggest moves. They are the ones who show up with a plan day after day and execute it with discipline. So, my challenge to you is this: don't just listen to this video and move on. Open a blank page and start writing down your plan. Decide what pairs you will trade, what sessions you will focus on, your exact entry model, your risk, and your whole journaling process. That simple act will put you ahead of the 90% of traders out there, because most traders never do this work. And the work that you're avoiding is the one that is going to put you ahead of the unprofitable traders. And I know you will. And that's why you will win. Video, I wanted to take you through a simple guide of how I do my trading plan. So, first of all, what I'm looking at is a trading plan should be followed by what? Let's look at my own components as an individual. We have what we call structure. That is the first thing that I need to consider. We have structure as the number one key thing. That is what I consider first. I consider, where is the market heading? Is it in an uptrend? Is it a downtrend? That is what has guided me all along. Then the second thing that I consider is what pairs, currency pairs, or my watch list. And I'm actually trading only two pairs. Only two, because even one pair can make you rich. But let's say at maximum you should be having three pairs, right? So my watch list should be having like three pairs only, right? Then, after that, I'll ask myself, what is my risk management criteria? And the risk management criteria is also followed by an entry model. So, risk management is something very, very important before you even think about doing anything else. So, my risk management criteria, I know that even if before I even take a trade, I know how much I'm going to risk on this trade. Then, number four is my entry model. What am I using to enter the market? I don't just randomly wake up and take a trade. No, I will say if I see a breakout, if I see a pullback, that is when I'm supposed to be entering. And then number five is, how do I journal down my trades? I will journal down, I will do back testing. I'll ask myself, okay, what has happened in this trade? What was the outcome? And did it help me as an individual? So, did I have emotions while I was in the trade? If so, how can I come out with a way forward? How can I stop this happening to me, right? So, that is a simple step by step guide of my personal trading plan. I hope you can apply this to your own, and trust me, it will be helpful if you try to do it. If you try, trust me, it will be so important and very, very helpful.